Hi, Mark Anderson here, mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. For today's mortgage rate update, what I wanted to do is a little bit different than what I normally do. Normally, I've got a live bond price chart, and we talk about the various movements in the bond market and how that's impacted rates throughout the day. Today, I'm going to look at some historical data, meaning data from yesterday. And what I wanted to do was track through the day and cover what happened as the bond market moved, and to explain how those bond price movements impacted the pricing that I had through my best priced investor for a particular scenario involving a 15-year fixed mortgage. Now, from a compliance standpoint, I do have to make it very, very clear that the rates included in this video are included for illustrative purposes only. They're not meant to be a quote. To actually develop a quote, I need a lot of information. The cases it's all very case specific in terms of credit score, the overall loan amount, the appraised value. There's a lot of different data there that I need to actually build a true quote. These numbers are included just for representational purposes to explain how rates move throughout the day. So what we've got at 9:30 in the morning, in Paramount Bank, we're what's called a correspondent lender, which means we have access to a bunch of different end investors that will ultimately purchase the servicing rights of the loan. The good thing about that is because we have so many investors to choose from, if some investors aren't very well priced that day, if, say, they have responded to some of the capacity issues that I've mentioned, there's some lenders that really just took on, I guess, too much in the way of new refinance locks, they're going to price themselves out of the market. So what's good is I have a ton to choose from, and we can simply work with the investor that has the best price at a particular time for any particular interest rate lock that I want to put together. So what we're going to do here is at 9:30, the bond price at that time for the particular Fannie Mae bond that I look at and track, the bond price at the time was 104.09. And at that time for this 15-year fixed scenario, the low rate option was 2.75%. And what this negative there in front of this number, what that indicates is at this rate, the bank is actually not earning our total target revenue. And so what this negative means is that we would have to actually charge the consumer negative 0.125. What that represents is 0.125% of the loan amount in the form of a discount fee. So basically, in order to offer this 2.75% rate, we'd have to charge this 0.125% fee. So that's where you get the term discount points. Just as an aside, discount points are almost never in like single whole increments. It's almost never the case that it's one discount point equals this amount in rate reduction. It's always dealing in decimals and fractions of a full amount. Now, interestingly, I thought this would be a nice way to illustrate a concept that I find is sometimes difficult to explain. At this same time, my best priced investor, I could go 2.75 and charge a little bit of a discount fee, or we could do 2.875. And you'll notice at 2.875, I've got a positive figure here. This is the exact opposite of a discount fee. This is what's called a lender credit. And in the same way, mathematically, as negative 0.125 translated into 0.125% of the loan amount, my lender credit in this case is an amount that pays us over our standard revenue target. And what it means is that take that loan amount, multiply it by 0.375%, and that's the amount that I can pay for the consumer's closing costs. At this same time, if we keep going up the rate sheet, we get a rate of 3.0%. And you'll see in this case that lender credit is just that much higher. Now, by the next slide, you're going to see 11:30 a.m. The bond prices at this time had fallen. They'd fallen to 103.92 at 11:30 a.m. And we started seeing negative price notices come in from our various investors. The argument that I made in my last video is that it is no longer the case we can rely totally on the bond market to tell us when rates are going to get better, because we see giant swings up in the bond prices and we don't see necessarily what I would consider a proportional drop in the rates. Conversely, mortgage investors seem very sensitive to falling bond prices, and they're very, very quick with these negative price adjustments. So as soon as this bond price went down, the notices of negative price adjustments started coming in. And so for this particular scenario, all of a sudden at 2.75%, there was a very small discount fee that was required at 9:30, just 2 hours before. And in this case, that discount fee jumped up to 0.477% of the loan amount. At that same time, at 2.875, I had a pretty healthy lender credit at that rate based on the 9:30 pricing. By 11:30, that completely fell away. This would be kind of your standard benchmark rate because there's no discount fee and there's a very small lender credit. At that same time, 3.0% had basically a 0.7% lender credit. That lender credit dropped to this 0.255 level. Okay, go a little bit further into the day. More price changes for the worse. We see the bond prices fell again, in this case to 103.81. This is about the lowest point of the day for the bond market, and you'll see the impact in the rates. Now, I'm not even going to share what the pricing was at 2.75 because at that time, the discount fee required to obtain 2.75 was very significant. So if I was talking to a consumer, this would probably be the rates that I would be looking at the time. 2.875 requires a 0.356 discount fee in order to secure that interest rate. 3.0%. In this case, again, pricing has gotten worse, 3.0. In the beginning of the day, there was a very significant lender credit associated with that rate. At this time of day on this 15-year fixed program, there was almost no lender credit and no discount fee. And then 3.125, we see a small lender credit associated with that. So over the span of just a few hours, I hope that this conveys in terms of the scale. When we talk about pricing changing through the day, I think one of the things missing from my previous videos is any sense of scale. Like what does it really mean? And I hope that this illustrates pretty well what price changes look like as this tracks these various price changes that we had throughout the day. A couple things to note. The pattern that I identified in a video, maybe this is about a week and a half ago, there does seem to be a pattern of better pricing available in the morning as the Fed is actively buying bonds. When the Fed stops buying bonds later in the day, the pricing does seem to get worse. So I have pretty routinely now been finding the most favorable pricing in the morning, and that's when I'm doing most of my locks for clients. If you call me in the morning, one thing that I have to note is that I do have to prioritize getting consumers locked in. I've got a lot of people that may have been sitting on the fence or they're just waiting for that right time to lock in, and I do have to prioritize getting those locks in place. One more thing that I wanted to share in this video that I thought would be interesting. I've mentioned that Paramount, we are a correspondent lender. We have access to a ton of different investors when we're pricing out your loan, which means that we can go wherever the best price is. Thought it would be interesting to share with you what the worst priced investor looked like at 2 o'clock when the bond prices were at their worst levels of the day. We were looking at rates in the 2.875-3% range on the best price investor, and the worst investor, they looked like this. 3.625% would require a full half point in discount. Now, this is the reason why I'm sharing this. This data wouldn't really have any relevance to my interactions with any consumer that calls in because I'm not going to be looking at this investor's pricing. But I did want to make a point. Big banks right now, and I know this is a generalization, this is not meant to say that every big bank that this is going to apply to, but a lot of your big box banks, when you go to get a loan quote from them, they don't have a ton of different investors that they're looking at. They're a big bank. They've got their big bank rate. Now, there are many cases where big banks are incredibly competitive. In my experience for right now, and again, this is a vast generalization, I'm not naming any particular bank, but the big banks, they are the ones that are the most sensitive to the capacity issues that I've mentioned in these videos. They are full of locks. And I have noticed a tendency for their pricing to indicate that they basically don't want the business. So again, just to reiterate one final time, I don't know what your particular big bank relationships are or what rates they're going to be able to offer you, but it's just an argument that if I'm in your shoes as the consumer and I'm shopping around, if I've got a quote from a big bank, I would want to talk to maybe a correspondent lender, maybe talk to a mortgage broker, somebody that's got access to a lot of different investors. The volatility right now is not only being driven by the changes in bond prices, it's also being driven by the individual investor appetite. And as those appetites change, sometimes they're pricing themselves really not very competitively at all. And so if you want to make sure to get the best deal, especially now, it does pay to shop around a little bit. So I hope you found this useful. If you have any questions, feel free to give me a call or shoot me a text. Thank you very much for watching.